let's get started. My name is Andrea Krupp, and I am the Director of Estate and Planned Giving at Providence College. I'm honored to have three esteemed colleagues here presenting, and I'm going to introduce Dr. Vivian O'Carey, Professor of Finance in the Providence School of Business. Dr. O'Carey has a PhD in Resource Economics from the University of Rhode Island. He is widely published. He is sought after as a speaker internationally and a much loved professor at Providence College. So it is my honor to welcome you, Vivian, and have you kick us off with an introduction of our other two friends here this evening.
Thank you very much, Andrea, for your generous introduction. Good evening, everyone. With me, I have two good friends of mine who are superbly proficient in investment management, and I'm honored to introduce them alphabetically, beginning with Alfonso Complido. I call him Al. Al is a CFA charter holder, Chartered Financial Analyst. He is the founder of AMP Consulting Group, an outsourced chief investment officer practice. His organization produces market research, commentary, and portfolio management services to independent financial advisors across New England. Al is also the Director of Investment Strategy for Independence Financial Partners, a comprehensive wealth management firm with more than $2.5 billion in assets under advisory. Al also serves on the Rhode Island State Investment Commission, where he helps oversee the assets of the state of Rhode Island pension system. And luckily for us at Providence College School of Business, we were privileged to have Al as an adjunct professor teaching one of our courses in the department. Our second participant, Dr. Marcin Krolikowski, is currently an associate professor of finance at Providence College in the Department of Finance. He is as well a co-head of investment strategy at Independence Financial Partners, where he advises on market research and analysis, asset allocation, and portfolio construction. Previously, Marcin worked for Citigroup on their emerging markets desk, trading primarily fixed income instruments. He is as well a chartered financial analyst holder and the current president of the Providence CFA Society. Please join me in welcoming Dr. Krolikowski.
Thank you, Vivian, and welcome to everybody. We're excited to present what we have. So kicking it off, we'll just have here a little synopsis of what to expect tonight. The first thing that we are going to look back is what happened in 2020. And the macroeconomic landscape has substantially changed in 2020 versus what has been in the past decade. So we'll basically look at what has happened in, last year and some of the drivers responsible for that. We're then going to look what we expect to see in 2023 and beyond, and where some potential opportunities might lie. We're then going to shift focus towards the Secure Act. And finally, we'll look at some behavioral finance implications, which a lot of investors have and potentially could be a drag on your returns. And some of these aspects you might not be even aware of.
And just a quick correction there, it's 2022, because I'm sure none of us want to relive 2020 for one more day. So again, welcome everyone. And we'll just start with a bit of a recap of what happened in 2022. It was really an outlier year for all intents and purposes. And that seems to be becoming a recurring theme here, where every year seems to be another year of unprecedented performance or happenings. But 2022 really confused a lot of people, including policymakers and leading economists. And if there's a chart that helps explain how do we wrap up what happened in 2022, we really think it's this one here, where going into 2022, so at the end of 2021, there were expectations by the Fed and by leading economists on where inflation would be and where the Fed funds rate would be. To simplify that a little bit, the Fed funds rate is essentially the pricing of money set forth by the central banks. And inflation, the CPI, that's essentially just the inflation that you hear that everyone's been concerned about. And at the end of 2021, the expectations for the Fed funds rate, which essentially sets the cost of money, which we'll talk about why that's important in a second, they were projecting that that would be somewhere around 0.75%, a little under 1%. And then for inflation at the end of 2021, the projections there were for inflation to be right around 2.75. Well, both were pretty off by a wide margin. So Fed funds rate ended up closing not at under 1%, but about 4.5%. And the inflation rate wasn't 2.75, it was closer to 7.5. So you can see that coming in to 2022, the expectations of what the cost of money would be and what inflation would be were significantly mispriced or misjudged by leading economists and leading policymakers. And the reason that that's important for everyone here on this call, it's because it was the primary driver of why almost every asset did so bad in 2022. So to make things simple, we looked at a chart here of a bunch of different asset classes. And really last year, the only winners were the dollar, the US dollar, and crude oil. And you had some times where gold did outperform, sometimes where it underperformed. And that was pretty much it. If you owned anything else, you were seeing a negative in your portfolio statements. And that's because the cost of money changed. For a long time, it was very cheap to borrow. Rates were really, really low. And what the Fed did last year, because they found themselves behind the curve versus their expectations, is they had to increase interest rates pretty dramatically. What that ends up doing is that resets the pricing of almost every single asset. So that's really why you saw things tumble materially in 2022. It wasn't even because of bad economic conditions. And that's what sets the stage in the future of this presentation here for what we're looking at in 2023. So just know that the worst year we had last year in quite some time on different assets was simply because the cost of money changed. And if you look at how that feeds into people's portfolios, what we look at is a 60-40. And the reason we look at that is because it sets the central kind of, if you look at the spectrum of very aggressive versus very conservative, 60-40 is generally regarded in the industry. It's somewhat in the middle, some type of a balanced allocation, 60% stocks, 40% bonds. In most years, that 40% bonds help cushion from volatility because they tend to move in an opposite direction from the 60% of stocks that you had. That did not happen in 2022. And that is one of the biggest surprises for most people's portfolios. In fact, the standard 60-40 portfolio had the worst performance it had in over 100 years, which is really an important thing to mention because that 40% that people relied on or generally relied on to serve as a counterbalance to stock market volatility did not work at all. So if you were younger or you had a more aggressive allocation than a 60-40, if you were on the other side of the spectrum, depending on what you owned, you might have seen some really big losses. The NASDAQ, which is the proxy for the kind of tech stocks, was down 30%. Crypto was down 90%. That was a big thing people chased in 2021. Meme stocks, all of these things that were the high flyers of 2021 were down 50, 60, 70, 80, even 90% in some instances in 2022. For people that are more on pre-retirees and retirees, the 40% of your portfolio, the bond portfolio, that had one of its worst years. So if you look at the 10-year treasury as a proxy, 10-year guaranteed government bonds, those had their worst year in 300 years. Where there was really significant damage on even high quality bonds. And that's what caused that side of the coin to be pretty surprised. So long story short, everyone largely had a miserable time in 2022. And we want to explain a little bit about that and talk about what we see in 2023.
Before we go on to this, we just wanted to look at a little bit under the hood. So we know that on average, stocks fell. But if you look at growth stocks versus value stocks. And broadly speaking, growth stocks are companies with a relatively short tenure. A lot of these companies are not profitable. They're not making any money. Versus value stocks. These are companies that have been around for a long period of time. They're profitable, normally pay a dividend. What happened in 2022, as Al alluded to, is for a very long period of time, interest rates were at zero. So a lot of individuals didn't want to place their asset earning a 0% rate of return. They were able to borrow at a relatively low rate and invest in growth stocks, which have a higher expected rate of return. Now, what happened in 2022 is interest rates increased, and due to that, a lot of investors shifted their capital from growth stocks to value stocks, causing basically a turnaround of what has happened over the past 15 years, where growth significantly was outperforming value. But last year that changed, and value actually outperformed growth by about 20%, given due to the change in the macroeconomic environment and specifically the interest rates.
Hey guys, wait 1 second. Marcin, can you go back to that slide for 1 minute and just give me an example of a growth versus value fund? So when you're talking about the growth line versus what would Amazon be, for example?
As I say, a growth company is normally not profitable. So Amazon is slightly profitable, but a good growth company might be, for example, Uber. So a lot of these companies are investing a lot of capital right now in order to hopefully make profits 5-10 years down the road. Tesla, actually, for the past 10 years was not profitable. So what they were doing is they were building up the infrastructure, losing a lot of money initially. Investors are not really worried about that because they are more long-term focused. So normally these are companies, as I say, that have relatively recently are traded on an exchange. Potentially they are not making a lot of money. Companies like an Uber. And value companies, as I say, are more established. A name like Coca-Cola comes to mind, been around for over 100 years. They normally don't have that many profitable projects. And as a result, because they're making profits, they normally pay out a lot of those profits in the form of a dividend. But their cash flows are much more easily, can be much more easily projected. And these are your household names, which a lot of investors are probably familiar with. As I said, and a good example is McDonald's or Coca-Cola. So hopefully that answers your question.
It does. Thank you. I'm sorry.
Okay, no problem. Now here we have an interesting diagram looking ahead, and without going into too much detail about this, basically when the ratio is high, so this is basically a valuation measure. When this is high, stocks are expensive. And when this is low, when this measure is low, stocks are considered to be cheap. So looking historically, we can see that in 2008 and 2007, stocks were considered to be cheap, and this was a great time to buy. While in 1997 and basically 2021, that black line reached nearly the 98, 99 levels. That is when stocks were expensive and were a good time to basically sell some of your stocks. So you might ask, where are stocks currently right now? As you can see, stocks are trading roughly at a fair value. But what is also interesting about this diagram is that stocks often overshoot and undershoot relative to their fair value. So when stocks are going up, as they have been since 2008, you can see that black line was way above the green line, which is the one standard deviation away from the average. Similarly, when stocks are going down, as they topped out in 1998, they didn't just stop at the average, where the average was roughly in 2003. They actually continued to get more cheaper, bottoming out in 2008, okay? So what is important over here is, yes, stocks have significantly have become cheaper since 2001, but if you look at historical trends, often that line is going to continue to go down, and potentially stocks are going to become even cheaper in the near term to potentially a longer term time period. Now, what is often also talked about in the media, and also not all talked about, but a lot of companies are laying off employees. So you've probably seen Google, Microsoft, McDonald's. letting off a lot of employees because a lot of these companies overhired when interest rates were low. When times were good, these companies were making a lot of money. They hired a lot of the workforce, and now a lot of these companies are basically laying off people. This potentially might present the problem as people are laid off. They are not going to be purchasing a lot of product. So for example, if you are laid off from work, you're not going to be buying $100,000 car. As a result, a lot of companies that that have laid off employees potentially might have a decrease in profits. So this diagram basically shows what has happened to earnings of companies when an economy was in a recession. And we likely are going to have a recession in 2023. And as you can see, that going back over the past 70 years, when we had a recession, earnings of companies decreased by about 17%. Now, what does that mean for stock prices? The average fall in the S&P 500 was about 30%. So it wouldn't be out of the realm of impossibility that if we have a recession this year and stocks go down by about 30%, which is roughly the historical average, the S&P, which closed by around 4,000, it's not out of the realm of possibility that we might even touch the 3,000 level if we have a recession. So we need to be open to a wide variety of outcomes, and one of these outcomes is a possible recession in 2023.
Yeah, and when we look a little bit in terms of just Bloomberg economist surveys of the probabilities of recession over the next 12 months, you can see that recession is becoming increasingly the consensus amongst a broader array of different market professionals. So as of the end of last year, Bloomberg economist survey showed that the probability of recession over the next 12 months for the US stood about 65%. For the EU, which is the European Union, the Eurozone, that stood at about 80%. They have some distinct challenges that are a direct result of the Russia-Ukraine conflict in terms of energy and things like that. The UK at about 90%, Japan at 30%, and China about 15%. So that you can see for most Western economies, the probability of recession over the next 12 months is certainly elevated. And there's a few reasons for that. And one of them is as you start increasing rates, you start getting damage and impacts to the real economy. So the reason that central banks will raise interest rates is because they're trying to slow down inflation by slowing down economic activity. So almost by definition, the reason you're seeing the things slow down, the economic forecast slow down, is because that's being done on purpose by central bankers. That's their primary mechanism to get inflation to start coming down. And the reason they're so aggressive with that is because inflation over the long term is really destabilizing to the everyday person. None of us want to walk around and be paying $5 in gasoline every day, or see a carton of eggs suddenly cost $15. Like these are things that central bankers really have to get out in front of. The issue is that there's a lag effect from when they actually start making money more expensive and raising rates to when it actually starts to translate into the economy. There's some areas where you have an immediate effect. So anyone that's been looking at real estate and knowing that in 2021, you couldn't put in an offer without putting it 15% above asking price. Everything was just flying off the shelf. Now you're starting to see things sit in the market. Now you're starting to see people price their houses a little bit lower than estimate. And that's because mortgage rates are double or 60% higher than what they were just a year ago. So the changing of pricing, that's an easy way for you to think of that. The cost of money has changed, and that's how it affects the pricing of assets. If you look at this chart here, the issue is that the big damage from some of the Fed's rate hikes so far, and this is a great chart from BlackRock, those are likely not to be felt until mid to late this year. Though we're talking about all of the things that they did last year, won't be fully priced in until the middle towards the end of this year. And it's expected that the Fed is still having a couple of hikes left, and they're trying to get to about 5% as a terminal Fed funds rate. So you can see that even though we've had some slowdown and some damage in terms of the pricing of assets, the economic damage is still in front of us. We haven't hit that just yet. One other thing that we always take into account that's we should be reminded of, especially in the wake of last year's Russian invasion of Ukraine, is that there's a heightened geopolitical risk right now that shouldn't be ignored. And the reason this is important is because the market really goes sometimes on market sentiment and how people are feeling. And if we're going into a recession economy and people are not feeling all that great and earnings are starting to slow down, historically, it's been something else that gets you to that real, we'll call it capitulation, but that's just when markets really start free falling. And generally, that's something external, something like a geopolitical event. BlackRock also has this great chart where they looked at kind of a geopolitical risk indicator, where they basically looked at a bunch of different articles and they used different frameworks to assess whether those articles are positive or negative. Long story short, coming into this year, we're at an elevated level of potential geopolitical risk, whether that is the Russia-Ukraine war heating up and kind of spreading into potential NATO territory, whether it's our contentious relationship with China, which is a big economy that's coming out of COVID. All of these geopolitical risks are things that matter more in a year like this than others, because we're already in such a fragile space. And it's usually when you're in a fragile space and then something external happens that you get into these potential free falls. And we want to make sure that people have the right temperament and behavior during that time period.
So given this backdrop, where do we see opportunities in 2023 and beyond? One of the key opportunities where this diagram shows well is in bonds. When the CPI decreases by more than 1% over a given 1 year, bonds have a significant high rate of return of about 6.1. Inflation peaked out at about 9.1% a couple of months ago and is currently on a downward trajectory. So given the historical data, and most likely that the next move from the Fed is potentially going to be a cut in rates, a good place that we see opportunities are going to be the fixed income market, where you're going to be able to get a higher rate of return. Another opportunity where we see is also...
Alan Marcin, given that you are a resident experts in this area, could you advise or audience and give them, I know the source of this information is from Bloomberg and BlackRock. Mm-hmm. What's your, and you know the common saying that when you have two economists in a room, they don't agree on the same concept. Given your expertise in this area, what's your gut feeling, either for or against what BlackRock is predicting for the benefit of our audience? Well, you are a resident expert, so, two economists never agree when they're in the same room. So you can't go wrong with your guesstimation because everything is a forecast. Mm-hmm. So do you agree with BlackRock on what the future portends, or do you have any ideas that it might not be as bad as BlackRock is projecting?
Well, that's the thing about, as you point out, Vivian, about investments. There's never any certainty in the financial markets, and if inflation continues to surprise on the upside, there's some economists which are basically saying that the Fed might have to take the federal funds rate above the rate of inflation. Now, if that happens, bonds are going to sell off. So if inflation does continue to the upside, then this statement might not be true. But if we're likely seeing the path which inflation has been on, it's likely going to be on a downward trajectory. if I was a betting man, yes, that can happen where inflation can be persistent and even move higher. But what we have seen over the past couple of months is inflation is moving down, and the next move from the Fed is most likely going to be a cut in rates rather than a hike.
Yeah, and to add a little color to that, Marcin and Vivian, part of the future is always unknown. So nobody has the right answer. Everyone's making their kind of educated guess. But one thing we know is that the current yields you can get today are better than almost at any point in the last 12 or 13 years. So just from a starting point, you're getting more yield today. And the reason that matters in bonds is because if you look at returns on bonds over a 10-year period, that return you're going to get over 10 years is about 90% correlated to whatever the current yield of that bond is today. So just on its face, I think it would be a true statement to say that bonds today are certainly giving you a better potential for returns than they have in almost any time in the last 12, 13 years. That's the starting point. And then to Marcin's point, if you have reducing inflation and inflation looks to be slightly going down here, that can be a tailwind for them. And then also if you go into a recession and the central banks have to drop rates to stimulate economies, that could also be a potential tailwind. All of that, to Marcin's point, gets upended if inflation tends to be a lot stickier and then it doesn't go away. And then the central banking policy has to stay more aggressive. So that's kind of the flip side of the coin there. And to Marcin's point, the pathway of how the Fed approaches it is going to be pretty important and what inflation ends up doing here.
And just to add to Al, bonds had the worst year in over 100 years. So you want to buy assets that are cheap. If I told you the last year was the worst year in stocks over 100 years, you shouldn't be scared of that. You should be buying into that. So just on the basis of that, because bonds had such an outlier year, they probably considered a solid investment. Thank you for your question, Vivian. Where else do we see opportunities? We see opportunities in emerging markets, predominantly in India and China. The chart to the right basically illustrates how many people are going to be added to the middle class till 2030. Now, as we know, economic growth is going to take place when more and more people are going to be added to the middle class. In the Asia-Pacific region, this is the clear outlier in the global economy. About 883 million individuals are going to be added to the middle class in India, and close to 500 million individuals are going to be added to the middle class in China. Those individuals are going to be buying things like watches, like iPads. So that is where the growth is going to be taking place in the near to long-term future. If you look at the developed markets, the United States, Europe, there is not much individuals being added to the middle class. So on the basis of that, we see a large amount of opportunities in emerging markets, especially given the type of year that they had last year. The dollar is probably likely going to depreciate a little bit this year, and that is going to create a tailwind for emerging markets.
Yeah, so and just to give that a little bit of color there, it doesn't mean suddenly go ahead and just make your entire portfolio Indian and Chinese stocks. So that wouldn't be prudent. There's more risk that goes there and there's some volatility there. So what we always try to talk to clients about is what's that mix? And what we've done some research and you found that if you go back to 1950, a mix of 70% US stocks, because we're all US investors, we tend to be more comfortable investing in US stocks, paired with about a 30% sleeve of international stocks. If you look back to 1950, that's historically that 70-30 mix has given you the same return as just the S&P 500 portfolio, but with meaningfully less risk. And the reason that happens is that different things tend to happen at different times and markets tend to zig when the other ones zag. So if you get into a period of US weakness and potential dollar weakness, that can be good for international stock markets because they benefit from weaknesses in dollars and vice versa. And you see these trends happening, periodically, and they oscillate. So We always have favored that 70-30 mix because there's some quantifiable evidence that shows that it reduces risk for you. And it goes back to the old adage that you don't want to put all of your eggs in one basket. That's probably the central tenet of risk management in our industry here.
So Al, this 70-30 mix is the stock portion of your 60-40 overall portfolio, right?
That's
So,
right. That's
okay.
Yeah, so for the stock positions you have in that 60, for example, in that 60-40, about 70% of your stocks being in the US and about 30 being diversified across international markets has historically been a nice risk-adjusted mix for people. And then just kind of closing out some of the opportunities that we see here. Dividends are also been a focus for us for the last couple of years at our firm and to the clients that we advise. And that really helped us out in a year like last year, where we had been advocating for that in 2021. But there's a reason for it. So dividends play increasingly important roles during periods of increased inflation and higher inflation. So what this chart here shows is going back to the 1930s by decade. The darker green line is total return of the stock market. And then the blue region there is the dividend incomes return. So the dividend incomes percentage of that total return. Generally speaking, if you go back to 1930, dividends make up for about 40% of the total return of the market. Where you had a big outlier year were in the 1970s, where it was about 72% of the total return over that time. A lot of people have an analog to this current environment to the 70s because it was an area of persistently high inflation. And when you hear people talking about inflation hasn't been this high and this persistent in over 40 years, 50 years, what they're referring to is that time period in the 70s, where it's really hard to get inflation under wraps in the 70s and into the 80s. Now, the things that are going on in this environment are certainly different than that environment, but think about what happens in dividend paying stocks and more specifically, companies that can raise their dividends. So to Marcin's analogy of value versus growth earlier, if you have a company like Coca-Cola and you go to buy a can of Coke and that costs $1, and let's say inflation is 20% over a couple year period. Well, if Coca-Cola makes that can of Coke $1.20, none of your buying habits is going to change. The 20 extra cents is not going to change whether or not you go and buy that can of Coca-Cola. Well, there are many companies with products like that can be resilient in the face of inflation and give the opportunity to pass along inflation pressures to and customers with very low friction. Think about a Tesla on the other side of the coin. If a Tesla starts at $100,000 and you have 20% inflation, that Tesla is now $120,000. That $20,000 may very well change your ability to buy a Tesla. So there's a little bit of intuition here in terms of why these dividend companies perform well in inflation. It's because those boring companies with pretty predictable business models can pass along inflation better than some other different companies can. So it brings us into the next segment here, and there's the Secure Act. So the Secure Act 2.0 were some changes that are made that I think are really important for everyone to know, and certainly for people to get familiarized with, no matter what stage in life you are on, and no matter where you are in your investing time frame. So there's 9 major changes. We're going to go over a few of them here topically. I'll probably in the chat include a link to a Fidelity article that gives a little bit more color, but it would be a good idea for people on this call to look into this because there are some meaningful changes that you should be aware of. So we separated this out into kind of 2 buckets, pre-retirees and retirees, and then younger investors who are maybe still in the accumulation phase of their life cycle here. So the first major change are changes to RMDs. So RMDs are just required minimum distributions. That's basically saying that at some point, if you hadn't taken money from IRAs, Uncle Sam wants to get that tax revenue, and you're going to have to start taking the money out whether you need it or not at some age. And that started at 70 and a half. End of 2019 with the first Secure Act, that was raised to 72. And another meaningful change here is that's now been increased starting in 2023 to 73. So if you turn 72 before 2022 or before, you still have to take those RMDs. But if you turn 73 in 2023, you can delay your RMDs till that age. It's also going to increase to 75 by 2033. So just keep that in mind, that the age for RMDs is getting extended over time. Another thing that you should be aware of is that the penalties for failing to take an RMD, that actually reduces, excuse me, from 25%, I'm sorry, for 50% if you fail to take your RMD in any given year, down to 25%. And then down actually to 10% if you actually correct that in a timely manner and correct your taxes in a timely manner. So those are important things to know there. And then also for people who have money in a Roth 401k, you used to have to take RMDs from that, even though it was a Roth account. Now with the changes in the Secure Act, you no longer have to take RMDs from Roth 401ks for that component there starting in 2023. There are also higher catch-up contributions. So starting in January of 2025, individuals between 60 and 63 can make catch-up contributions of an additional $10,000, which actually will then get indexed to inflation. So there's some income limits there. You can read a little bit more about it in the article that we post on the chat. And those indexed to inflations are based on federally determined cost of living increases, generally tied to CPI and a couple of other metrics. But that's an important thing to know. You'll be able to put more into catch-up contributions to save for retirement if you're a pre-retiree and getting ready to start retiring. And then also our IRA contributions are going to be more purposefully adjusted for inflation based on that same federally determined standard there. Matching for Roth IRA accounts, right? Roth IRA accounts. This is a big deal here. And I think this is a big deal. I put it for everyone and for the pre-retirees and retirees, but it certainly impacts younger investors as well. When you are in a workplace plan, usually any matches that you get from your employer were on a pre-tax basis. So that means it would match to your traditional IRA component. Now, employers can actually match vested contributions from an employee in their Roth accounts. And for anyone that's young, Roth IRAs are really a great way for you to save. The difference is in a Roth, you're putting in after-tax money, so you're not getting a tax benefit today. But the benefit is down the line, when you take the money out, you don't pay taxes then. So you get all of that time of kind of tax-free growth. Then when you take the money out, you still don't pay taxes. So to have a match on top of that, that's just a wonderful, wonderful thing. And that's something that specifically younger investors should be using. And then even if you're a pre-retiree and a retiree, we do see a lot of clients sometimes starting to beef up those Roth buckets later in years because they anticipate higher taxes in the future and they want to create a tax bucket. That's also an interesting perspective there. I'm going to skip QCDs for a second. We're going to get back to qualified charitable distributions there. But another important update was QLOCs, and QLOCs are qualified longevity annuity contracts. A lot of people don't know about these, but they're essentially the highest kind of actuarial kind of mortality credit built annuity. So that basically you're putting money in up front, you're waiting a long time before you take the money out, but the payments you receive in the future are pretty substantial. We've seen some where you're getting, 15, 20, 25% of the money you put in on a yearly distribution. Before, there used to be caps on how much you could put into that from your IRA dollars. They've now eliminated those caps. It used to be capped at 25% of your total IRA balances. There's no longer a cap anymore. And they've also raised the amount that you could put in there to $200,000. It used to be $145,000. So for people to protect against longevity risk, and what that is just the risk of me living a long, long time and my assets have to support me over that entire time frame. qualified longevity annuity contracts can be an interesting way to hedge longevity risk.
Okay, now a couple of points.
One thing, please don't skip the qualified charitable distributions as the estate planning person in the room. That's
Will
an
do.
important one.
Absolutely.
Definitely. And now some changes in rules for younger investors. The first one is automatic enrollment and automatic plan portability. This basically means that businesses adopting new 401k and 403b plans will now automatically enroll eligible employees. Employees will have to opt out rather than opt into the plan due to automatic enrollment. So you'll be automatically enrolled into the plan. Also, when you want to change jobs, you can simply transfer those assets over. You don't have to be cashing them out. So this was a problem often for individuals with low balances that used to take their money out, pay taxes on it, and this was not a good strategy. Now you can simply transfer those assets over. The second important point is emergency savings. So defined contribution retirement plans would be able to add an emergency savings for non-highly compensated individuals. Contributions are going to be limited to $2,500 annually, and the first 4 withdrawals are going to be tax-free and penalty-free. An emergency savings fund can encourage plan participants to save for the short term and as well as unexpected expenses. The next point regards student loan debt, which some of you on this call might have. Starting in 2024, employers will be able to match employee student loan payments with matching payments to their retirement account, giving workers an extra incentive to save while paying educational loans. And the final point goes regarding 529 plans, that after 15 years, 529 plan assets can be rolled over into a Roth IRA, subject to annual Roth contributions, which right now are $6,500, and in aggregate, you cannot transfer more than $35,000.
Arsen, can you, if I hold a 529 plan for my children and don't use the whole amount, can I roll it into a Roth for my children, or does it have to be in my name?
You can roll it into your children's account. Yeah. As long as that clause of 15 years has been satisfied.
Thank you.
All right, and getting back to QCDs, which are qualified charitable distributions, that's what that stands for. And that's important for anyone here that's interested in giving. And I'll give some context to what that is. So what those essentially were or are, those are direct transfers from your IRA that are paid directly to a qualified charity. And where a lot of people use these are especially retirees who don't necessarily need their RMD. And they're looking for a way to give and fulfill some of their philanthropic aspirations that also gives some type of a tax benefit to them as well. So the initial kind of the benefit here was that if you didn't need your RMD, you could do a QCD, give it to a qualified charity that would satisfy your RMDs, and that would also get excluded from your taxable income. So generally speaking, when you take an RMD, that gets added to your taxable income, and depending where you're standing in terms of your marginal tax rate, that could impact your Social Security payments, that could impact the tax bracket you're in. So QCDs are a way that a lot of people use who are going to be giving anyway, to make sure that that RMD that may otherwise just get distributed, taxed, and then put in the bank, to do some type of good for them and to help meet their philanthropic aspirations. So starting in 2023, people who are 70 and a half and older can elect as part of their QCD income a one-time gift of up to $50,000, which will get adjusted annually for inflation based on those same federally determined cost of living increases. And that's really important because it gives you a chance to do those one-time benefits give to whatever charity or cause that you wanted to give to, and still preserve some of those great tax benefits that you get from that by eliminating it from your taxable income base. It's also expanded the definition of some of the types of charitable remainder trusts you can use. You could use a unit trust, an annuity trust, a charitable gift annuity. These are all questions that would certainly be good to talk to a tax advisor on. We don't like to give too much tax advice because everyone's taxes are different, and the things that impact one person may not impact another. But the long and short of it is you can do more giving, you can give more in terms of gifts, and they still have those great benefits of fulfilling your RMDs, but also then taking that income off your taxable base, which for many people can be meaningful, especially if you're on the margin in terms of stepping into another tax bracket. The savings can really add up in that sense. So in the link that we'll put in for some of the Fidelity articles that summarize this, there's an expanded section on QCDs if you want to look into it. But certainly Providence College is a great place to start. And that's a shameless plug there.
Al, I'm going to can you go back for, well, I guess it doesn't matter, but I just want to point out a couple of things. One, the RMD, so that's the required part of this distribution, required now at age 73, was 72. That means at that age, you have to take that money. With the qualified charitable distribution amount, you can take that money at 70 and a half, so you have the option of taking money out of your IRA, must be directed from your broker, your planner, directly to the charity. That can happen at 70 and a half. All right. So if you are want to do it earlier, you can certainly do that. You have to do the required minimum distribution has an age that is attached to it where you are required to. So I just want to make that. And we are talking about IRAs. So 401ks, these two things are not applicable to 401ks or any other kind of retirement fund. We do have a lot of folks who use QCDs and RMDs to give to Providence College instead of taking cash that they have sitting in a bank. This is one way that a lot of folks have chosen to give. So I just wanted to clarify those two things. Thanks, Al.
No, great point. And great point on making sure that it has to go directly to the qualified charity. This is where you want to make sure you use someone with tax expertise. If you take receipt of the RMD and then try to donate, that's not going to work. So make sure that you do talk to someone qualified in taxes to help you guys out, help everyone out with that. We're going to kind of finish this off on some behavioral finance implications. I know we're running a little bit late here, but wanted to make sure we leave some time for questions. So behavioral finance implications are something that are really important. Marcin, I'll let you explain this chart here before I get into some of these other ones.
Yeah, so behavioral finance traits, some investors are not even aware of them. And basically a lot of what characterizes a lot of this is investors often do the wrong thing at the wrong time. Vanguard did a very interesting study where they basically looked at the value of financial advice, and the most important reasons where financial advisors are able to add value is something relating to behavioral finance, i.e. preventing investors from buying things when things have ran up and selling things when things have gone down. So this is a very interesting study published by JP Morgan, that over the past 10 years, the S&P, which is the general market, has returned about 16%. But if you look at the average investor, which is in orange, the S&P is in green, the average investor has returned only about 8%. Now, the main reason for that is, as I just now mentioned, investors bring emotions into investing. And they buy when there's high exuberance. As we mentioned at the beginning of the presentation, people buy stocks in 2021 when they were expensive. And now when stocks have gone down in price and potentially might go lower, what they do is they often sell. Many people have sold, for example, in 2008, 2009, and never got back into the market. So this is basically a highlight that a lot of investors do the wrong thing at the wrong time, and often you might need financial advice and financial help in order to overcome these problems, which Al is going to allude to more specifically.
Yeah, and this chart really highlights what we're talking about here. And if the tenor or the tone of this conversation today feels pessimistic, we're here to tell you don't be. So the stock market works over time. 80% of the time, roughly, the market's going to be up and it's going to be in your favor. The 20% that it's not, people really tend to make poor decisions, and they can upend years worth of good planning at really kind of bad moments. And that's why we think this is such an important part to discuss, because if we're getting into rocky times, your behavior is going to matter most. And what you don't do is going to be really important here. So if you look at kind of this chart here, everyone knows that the market goes up and down. That's pretty well defined, that it goes in cycles. But I think framing it in this kind of emotional context is really what gets to the crux of investing, where most people, if you look at 2021, tend to really aggressively invest when markets are doing great, when everything's up. These are the maximum parts of euphoria here. And you can see here that this is where there's the most financial risk, because you're just buying more expensive assets. And then what happens is markets start going downwards. And initially you start getting a little anxious and maybe going into a little bit of denial, because we all know that the stock market works 80% of the time. This guy Al just told me that on the Providence College webinar. So we're going to be okay. And then suddenly it's not okay. It starts going down further and further. And then fear starts setting in. And then you're starting to get a little bit desperate. It keeps going down. The things that you bought in 2021, whether it was a meme stock or crypto or whatever, keeps going down. And then you finally get a point to panicking and saying, what am I going to do? The market keeps going down, and we have something that you call capitulation. This is just when you sell it, you say, okay, these things are going to go to zero. I can't take it anymore. I'm just going to cash in, take my losses, and just, that's going to be that. You have a little period of despondency there, and you kind of have a bottoming out process. And that bottoming out process is the point of maximum financial opportunity, because the golden rule of investing has always been to sell high and buy low. But from a behavioral perspective, that is so difficult for people to do, because the time that is great to be buying, you're not going to hear any good news on CNBC or the financial newspaper or Wall Street Journal. It's going to all be problematic. Everything's going to sound like the world's ending, but that's when things are the cheapest. And that's when you can get the best bargains. And if you look at buying low as kind of the starting point to generating wealth, it's the ability to control your emotions and almost think slightly counterintuitive as to how most people think, because most people want to buy high and chase things that have gone up, trying to get more gains. And then they don't want to kind of buy things when they're low. It's interesting that it's only in finance where people are more comfortable paying more for something than less for something. If a shirt that you loved was on sale, and you went to the mall, you saw it was a $50 shirt, and then next week it was $25, you'd say, wow, this is great. This same shirt that I love is on sale. I get a bargain here. It's only in finance that you'd be more comfortable paying 70% or $70 for that $50 shirt, because everyone else is paying $70 for that shirt. So that really speaks to your behavior, and understanding this chart. If there's any takeaway that you get from in this presentation today, have it be this chart, because controlling your emotions is going to be such an important part of your long-term financial outcomes. And just know that when things are the worst, that's probably where the best bargains are. When things feel like they're the best, that's probably the time where you should be thinking about managing risk. So we have a couple of games here in action, and we'll kind of go through these, and you can just quietly on your end, just kind of write down what you think your answer would be, and we'll kind of give it some context. So the first is, which would you choose? A is 100% chance of winning $3,000, or B, 80% chance of winning $4,000, but a 20% chance of winning nothing. Give you guys a second there. A, 100% chance of winning $3,000. Here's your $3,000 just for choosing A. Or B, an 80% chance of winning $4,000, but a 20% chance that you don't get anything. Got that? Great. We'll move on to the next one here. Now we're going to ask the question slightly different. Which would you choose? 100% chance of losing $3,000, So give me that $3,000, that's your choice, or an 80% chance of losing $4,000, but a 20% chance of losing nothing. I'll give you a second there to write your choice down. What does this speak to? This speaks to something that we call loss aversion. And that means that losses are psychologically more painful than gains. So what's the crux? What's the rationale here behind this game? In the winning scenario, that first question I asked, would you take a 3,000 up front or the chance of winning 4,000 versus getting nothing? The rational participant should choose B, as the benefits, which is an 80% chance of winning $4,000, are clearly greater than the cost. And the cost is foregoing that $3,000. But interestingly enough, most people choose A. Give me the $3,000 because I know I'll get it, versus that 20% chance that I might not get anything. I'm going to forego that $4,000, even though there's an 80% chance. If I selected 10 times, 8 of the times, I'll make that extra $1,000. So that's really interesting there. In the losing scenario, however, many of those same cautious risk takers who chose the $3,000, the upfront benefit, in the second losing scenario, most people actually choose B, the inferior option, where you have an 80% chance of losing $4,000, but a 20% chance of losing nothing versus a guaranteed loss of $3,000. So it's an interesting way to think of the fact that people are more likely to choose things that limit their losses as opposed to make them the gains. And that's an interesting part of behavioral finance. We have another interesting one here, and we'll kind of give your kind of a survey. So a study was asked of more than 400 doctors whether they would prefer radiation or surgery if they themselves became cancer patients. Of the doctors who were told that 10 out of 100 patients would die from surgery, half of those doctors said that they would prefer to be treated with radiation. Oh, 10 out of 100 dying from the surgery, I'll take my luck with the radiation. Of the doctors who were told that 90 out of 100 patients would survive the surgery, only 16% say they would choose the radiation. Well, what's the meaning here? If you look at those phrases, they're the exact same thing. You're just framing them in a different way, and we call that framing bias. So framing bias occurs when people make decisions based on the way that information is presented, as opposed to just on the facts themselves. So the same facts presented in two different ways, just like we're doing here to a set of doctors who are not just people you're talking to the street, asking them about cancer patients and radiation and treatment. These are doctors. These are people that live and breathe this profession. Even in that doctor cohort, just changing how you presented the information led to drastically different decisions being made by very informed people. So you should realize that even in this industry, even if you're a finance major, even if you're in the investment management profession, we all suffer from framing bias, which is how information is presented to us. Last one here that we'll do, and this is an interesting one. A candy bar and a piece of gum together cost $1.10. The candy bar costs $1 more than the piece of gum. How much does the gum cost? I'll give you guys a second to answer that. Everyone got their answer written down? All right. Most people say, well, the gum costs 10 cents, obviously. Well, that's wrong. And let's do the math as to why that's wrong. If the total cost of the gum and the candy bar was $1.10, and the gum costs 10 cents, and the candy bar costs $1 more than the gum, that means the candy bar would cost $1.10. The total there is $1.20. The correct answer is that the gum costs 5 cents, because if the gum costs 5 cents and the candy bar is $1 more than the gum, that means the candy bar costs $1.05, and then the total cost of the candy bar and the gum cost $1.10. Again, this is a brain trick here that when I first got the question, I got it wrong. Most people on this call probably got it wrong, so don't feel bad. But our brain is wired many times to think between your intuitive brain and your analytical brain. And this can be tough for analysis to override this intuition. When you first saw that question, your intuition probably immediately screams, well, it costs $1.10. There's two choices. The candy bar is $1 more. Well, then the gum's 10 cents. It's $1.10. But that would be wrong. And when you look at the analysis, that explains why. So it just speaks to the fact that your intuitive brain is going to play tricks on you versus your analytical brain. And sometimes in markets, what you think is supposed to happen doesn't play out in real time. And if you keep going on what you think and what your gut just says on markets, that could be a recipe for disaster. You have to make sure you're making decisions based on quantitative metrics, based on just facts and what's out there as they are accurate, not as how your brain might perceive them. So last here, Power of Nudges. We read the book Nudges by Thaler. I think a lot of people have read this. It's how you kind of create choice architecture to put yourself in a better position to succeed. The first is to use default options. So automatic enrollment in a 401k is an example of a default option. And you found that when you don't, when people have to opt out of something as opposed to opt in, outcomes get improved. So when you have automatic enrollment and you don't have a choice of getting in your 401k, you can get out if you choose. You see that participation rates increase dramatically. Another takeaway from that book was to use commitment devices. Setting clear and measurable goals for yourselves is very important to long-term success, but it's also important to keep those goals. So setting up different commitment devices that help you keep your goals and lock you into that course of action, whether it's signing an old personal contract, as corny as that might sound, sometimes that can be effective, or jotting it down in a journal or a calendar. Setting clear commitment devices to make sure you stick to your goals are powerful. And last but not least, harvest the power of fresh starts. A lot of research showed that if you use a fresh start date, most meaningfully your birthday, as the day to commit to financial choices that improve your long-term outcome, most people commit to them when they start on those fresh dates. Because going into a birthday, there's a lot of enthusiasm. You're more likely to want to really better yourself going into your next year. And by picking that date to start something for yourself, to benefit yourself, it's found that more people stick to it and commit to it and execute on that much more than if they just pick an arbitrary date. Interestingly enough, January 1st was not found to be an effective fresh start date. And a lot of us know that by the fact that we start our New Year's resolutions, and by February, that's kind of out the window. So birthdays can be a powerful one. Make sure you use those. In summary, and thank you guys for your patience. I know we ran a couple of minutes over here. 2022 was a tough year for almost all assets. 2023 may bring more volatility, but there are also opportunities within that. Bonds finally offer attractive income, and they could do well as inflation falls. International stocks could benefit from a weaker dollar. Remember that 30% rule, 70% US stocks, 30% international, give you this nice mix that helps reduce your overall risk. In the US, dividend growth stocks may offer some good combination of growth with some downside protection given their defensive features. The Secure Act has many changes to be aware of. And while we're going through some questions here, I'll type that link that I promised to make sure you familiarize yourself. Control your emotions as we head into volatile periods. Do not lose your cool. That's probably the best thing you can do to improve your long-term outcomes. Aside from this last piece, diversify. It's the best way to manage risk. Don't put all your eggs in one basket. As attractive as that crypto stock that your friend made 500% on in 2 months sounds, just don't do it. That's an easiest way to wipe yourself out. And finance is a game of just long-term time frames. As long as you can stay in the game, you're going to do okay. But don't get yourself out of the game by putting all your eggs in one basket that doesn't work out. Because life has shown us that even companies that are supposed to be secure end up not doing so well at some points. So we will pause there. Thank you guys so much. If you have any questions, you can reach out to the email below, but we're happy to take any questions here in the interim.
We do have questions, and so here's what's going to happen. I'm going to read through these questions. The Al and Marcin are going to answer as many as we can. We will also look at them afterward and see if we can get some answers out to you in an email. We are recording this this session tonight. We'll send this to you and to everybody who's registered. Feel free to share it with friends, watch it again, contact us. So let's get to these questions. Okay, so I'm going to go up here. Is there a limit for a QCD from an IRA? That's one
Nice.
question. Is there a limit for taking a QCD from an IRA?
Yeah, they've done the $50,000 as an expansion one-time distribution availability, but your RMD is generally what you can use for your QCD. So the limit would be to your RMD for that particular year, but there's not, you can do that in subsequent years. It's not like you can only do it one time.
So that $50,000 is that's the one-time lifetime to a charitable gift annuity or a remainder trust or some kind of life income vehicle, right? But isn't the QCD, you can take up to $100,000 for the multiple year. Every year you can take $100,000 from your IRA to a QCD. And then that renews every year. That
That's right. It
50,000,
renews every year.
right?
That's right.
So that $50,000, just to recap, under the Secure Act, it allows people to take $50,000 from their IRA and put it into a vehicle called a life income vehicle. So something that a charitable gift annuity is a good example. You buy an annuity for $50,000 and you enter into a contract with the charity that you've bought this gift annuity from. You are paid money every year for the rest of your life. And at the end of your life, whatever remains goes to the charity. Previously, you were not allowed to use money from your IRA to do that. Anything that paid you money through your lifetime was not allowed to come from your IRA. Now, that one-time life exception is $50,000 to go into one of those vehicles. Aside from that, every year, each IRA holder, so you and or your spouse, can each take $100,000 from your IRA to give to a charity, directly to the charity. Okay, so there are two things there.
Right.
Sorry, Al, I just wanted to make that clear.
Yeah, no problem. Oh, you're on mute, Andrea.
Sorry, thanks. If you were building a bond portfolio from scratch in a long-term portfolio, what type of bonds and what maturities would you use?
That's a good question. So while that's going to be a little bit specific to different people and the risk tolerances that they're able to accommodate, generally speaking, your shorter duration maturities, your shorter duration credit instruments that you're going to need that money in the future, we've been deferring to treasuries, specifically on the short end of the curve right now. They're paying relatively attractive rates. You know you're going to get your money back. And even though bonds could potentially be attractive, if we do have really outlier credit events, risky events in the short term where you start getting defaults or things like that, corporate bonds or high yield bonds could certainly have default risk. There's credit risk to those there. So in the short end, we favor kind of strong government guaranteed bonds, and you're also getting a pretty good yield there right now. As you extend maturities, you can start maybe going up the credit risk ladder, getting into then like investment grade bonds. And then as you go further along, things like higher yielding bonds, levered loans, things like that. But just understand that things like high yield bonds, levered loans, those have a lot of economic sensitivity. And when you have really bad economic conditions, you can also get defaults there, and you can also get losses on that end of the curve. So just like the stocks, where not all stocks are created equal, not all bonds are created equal either. So again, start on the short end of what you're going to need in the next several years, call it 2-3 years, buy really safe bonds, and then you can start kind of staging up from there.
Okay, given your recession outlook and the standard 60-40 allocation, would you suggest to modify this, example, to a 50-50 or even 40-60 allocation in 2023?
Yeah, this brings an interesting concept. So when someone structures a portfolio, remember that what you're trying to do is match the expected returns of that particular portfolio to what you're going to need over the long term. So volatility, or the perception of volatility, shouldn't be the driving reason as to why you have more bonds or stocks in a portfolio. What should be the driving reason is what you need to average as a long-term return to meet your financial goals. And if you look at it with that long-term purview, that's the decision-making framework from which you should start, because then you're going to get into a space where every time the market's good or bad, you might be thinking of changing your allocation in anticipation of something good or bad happening. And again, there's where mistakes can happen, because even if everyone expects a recession, well, there's a chance that you don't get one. And if you got conservative in an anticipation, or you changed your long-term allocation in anticipation of something that then didn't materialize or was not as bad as people thought, you're not using your rationale for having your allocation is not rooted in what's most important, which is, what is it that I need over the long term, and what portfolio, based on the mix of what those assets are supposed to deliver through time, can support me. So I'd be careful to match your portfolio that's a long-term allocation to short-term changes in recessions and what have you. Now, the way to maybe hedge that a little bit is sometimes we have our clients increase some of their short-term cash buckets, or safe money, let's call it, if they're worried about volatility. But again, that shouldn't upend your long-term asset allocation, which should be driven primarily by what you need in the long term as a return.
Okay, so here's an interesting one. What do you think is going to happen, or how long do you think it's going to take to affect? Sorry, let me back up. When are we going to feel the effect of the $31 trillion debt? When's that going to crush us?
I would argue we're feeling it now. Part of the reason we're in this inflationary problem is because you printed more money in 2020 and 2021 than you had in almost all of the wars over the last 100 years combined. And at some point, you have to pay for debt. So there's a lot of people debate this in meaningful ways. We're going to have an interesting conversation here as it relates to politics and what happens with raising the debt ceiling. That's an argument that's coming this summer. So it'll be interesting to see how that plays out. But certainly the long-term standing of the dollar as a reserve currency will eventually be put in question if we continuously print money and just take on more and more debt. One of the saving graces is that the entire world has taken on more debt. So Europe and Japan and countries that would otherwise be competitors to us, reliable competitors, I would say, or ones that even have a chance to be a competitor, they're in no better shape. They're arguably in even worse shape, and that saved us for a bit. And the countries that have account surpluses like China, they're nowhere close to being that as a reserve currency. You're going to hear interesting things about maybe oil starting to being able to be paid in other currencies, but nobody transacts in Chinese yuan. It's not anywhere near that. And I hear a lot of people say that, well, that currency might take over at some point. Not anytime soon. It's just,
and just to what Al is saying in the comments, one person said that we are forced to balance our checkbook. Well, we are forced to balance our checkbook because we don't have access to the printing presses. the government can print an infinite amount of money. And that's kind of what they have been doing since the financial crisis. The balance sheet has been going up. The Federal Reserve, the deficits have been increasing, and it's a very easy thing to get hooked on. So there's a lot of projections where the deficits potentially might be going down. The balance sheet is going to be reduced, but who knows what the future holds? Most likely there's going to be some crisis, and that crisis is going to be probably supported by additional printing of money, which is so easy for governments to do. And so kind of the people call it like crack. Once you kind of get hooked on it, it's very difficult to stop. And, every single administration since the Clinton administration has had an increase in the deficit. So no one has been able to stop it. And the problem is a lot of politicians don't really care what's going to happen 15 years down the road because they're not going to be there. They're just caring more about the future. And an easy answer is, well, let's just throw more money. Let's just print more money. That's going to cause growth and potentially give us more votes. So a lot of fact, it's a very difficult issue to address because a lot of the stuff that you might have to do as a politician, you're never going to win an election on that. One of the solutions provided was, for example, cutting Social Security. Now, who's going to win an election running on that, running on that idea?
That's right.
I'm going to read one more question that's a short one. Marcin, while I'm reading this short one, if you would read the longer one to yourself and see if you can come up with a short answer for that one. I'm going to read this. What metrics indicators would you primarily look at to determine a potential reversal of the downtrend we've experienced? The CPI report, federal fund rates, forward PE ratio. That means nothing to me, but you that's your speak, Al.
That's a great question. So we here personally use a multidisciplinary approach where we do look at fundamentals and we also look at technical analysis for some indicators. The first thing you want to look at least from where we're concerned, one of the most important things is, do you have washouts in sentiment? Meaning, is like everyone panicking to a point where you're just starting to sell a bunch of things? And historically, the VIX gives you some indicators as to when people are really hitting that capitulation phase. So they're getting to a point where they've completely given up and you're getting to some bottoming in of that process, that you'll usually see a big spike in the VIX there. Other than that, things that you can start looking for in terms of clues is going to be when a Fed starts to pivot in terms of their monetary stance. And they go from a very hawkish policy, so very tight policy, to start loosening interest rates, because the central banker's biggest response to stimulate economies is interest rates, changing the cost of money. When they want to slow things down, like right now to take inflation down, they're going to raise interest rates. At some point, there's going to be enough damage where the way they stimulate the economy again is to drop interest rates. So what you've been seeing, the fits and starts of the market, is the market doesn't believe the central bankers right now. The market thinks that the Fed is going to have to cut interest rates at some point this year. That's to be determined. We'll see how that shakes out. Anyone's guess is likely to be as good as another person's. But that's another clue when they start dropping interest rates, that you may have started getting into a more accommodative environment where there's going to be more liquidity in the system. When they drop rates will be because things are really bad. They won't drop rates because things are good. So that's another helpful thing to look at.
Just to add to Al's point, it's very difficult to pick the bottom. So the market bottom in March of 2009, but you really would have picked that as the ideal time to buy all the stocks. What you have to do is kind of buy gradually, because as stocks get cheaper and cheaper, the expected long-term returns go higher. And similarly, when stocks get more expensive, that is probably the time to let go of some of the securities. So all you have to do is basically look at the valuations relative to the historical valuations. And you might not necessarily pick the bottom or the top, but you're basically placing the probabilities in your favor that over the long term, you buying stocks at historically discounted valuations, or you selling stocks at historically overvalued valuations.
To add to that, we wouldn't be doing our job if we didn't say this. Markets are about time in the markets, not timing the markets. everyone can have all of the metrics they want. We can look at all of these things that are rational and well-defined and rooted in some type of rational thinking. And then the market does something completely different. So timing has never been something that anyone is good at. It's about time in the markets, keeping your allocations in there. Like Marcin said, if you have some doubts, gradually teaspoon feed in and dollar cost average throughout periods of discounted valuations. Those things are more effective than trying to say, well, what's going to give me an indicator for the bottom? There's some things that can help, but surely picking the bottom is a fool's errand. That's all but impossible.
Marcin, there's one long question. And do you think you can take a stab?
Can you help me out on this one? Because I'm not sure. What is
Yeah.
SMA projection?
Social Security Administration
Okay.
projection outflows exceeding inflows coming in 2032. How should one coming up on retirement best determine to receive payments earlier versus waiting to age 70, everything else being equal? So when it comes to Social Security income and planning for that and optimizing that, that is very much a conversation that's unique to different people and unique to spouses. There's a couple of things to take into account there. So if you're married and you pass away, the spouse is going to receive the higher of the two socials. So if one has enough income as a household and there's a tangible benefit for letting one of the Social Securities run as a hedge of protecting the other spouse, there's a clear kind of need for potentially deferring that. You might have the other side of the coin where someone's retiring at 62, they will not work until 67. It's just not going to happen, but they need the Social Security as a way to just make it in retirement. Then they're going to take theirs much earlier. There's crossover and kind of analysis that can be done in terms of where you break even, but largely people should look at Social Security as a way to hedge themselves in retirement. And that, unfortunately, is a question that's going to be too unique to different scenarios to give kind of a blanket answer. The truth is, to everyone, it's different based on what their unique circumstances. Thoughts on I-bonds? I see that there. I-bonds are great. You get a pretty good inflation rate. The problem is you can't size it. That you're capped out at $10,000. So you can't really buy much volume there. But for what you can buy, it gives you a pretty good return there. Thoughts on refining student loans with private lenders versus keeping them as they are in hopes of forgiveness? Hope is never a strategy, is what we've always learned. It's not that they won't forgive, but I think refinancing, you should always look at these types of decisions pretending or assuming that no one's going to give you anything, that nothing's going to be forgiven. And you should make the decision based on if you had to pay that loan for the rest of your life. And then if you do get forgiveness, then that's a cherry on top. That'll be a welcome surprise. But again, hope, you never want to bet on hope, because then you'll get let down, and that could cause other problems. And thank you for the positive feedback. We really appreciate
You
that.
only don't want to bet on hope in financial situations. In every other area of life, hope is what you bet on.
Right.
Hope and
That
love.
is exactly right.
Right?
Andrea. That is
Okay.
exactly.
Listen,
Yes.
I'm going to give you guys the biggest compliment I can give you. I went to law school in order to avoid taking math. My parents will tell you that's exactly what I did. And so this made sense to me. I enjoyed it immensely. And I think most of our folks stayed on all of them stayed on the whole time. And even going over half an hour, they stayed on. So you have done an amazing job. Thank you so much. I really appreciate your time, and I know all the attendees did too. You guys are rock stars. Thank you. Go
Thank you
Friars.
guys very much.
That's right. Go
Go
Friars.
Friars. Take care.
All right. Good night,
Bye.
everybody.
Good night.